Hey folks, Dan Farrow here with your rate update. Today, the Federal Reserve is going to come out and tell us what they are going to do. We already know what they're going to do. They're going to raise rates by 0.25%. I'm going to go over that in detail with you. But today we want to talk about the jobs report. Jobs numbers just came out, and I'm going to explain to you my thoughts on that because I don't think it was a surprise. You can see right here, private payrolls surged by 296,000 in April, much higher than expected by ADP. Well, ADP, if you guys are looking for an analyst, I would love to join you because you missed this by half. That's why I really don't use your data as reliable. So the next thing we're going to talk about is, and I'm going to show you why I think this isn't a big surprise. The next thing I'm going to go over is fake news. And there's two areas that we're going to talk about today is bank closures. Okay, I'm going to talk to you in detail about that because people are using that as a crutch in mainstream media and YouTubers and everything else. And then the last but not least, are we going to default on our debt? Janet Yellen came out yesterday. She's the Secretary of the Treasury, and she said if we don't do anything by June 1st, we are going to default on our debt. And the whole country is in turmoil right now. Is that fake or fiction? I'm going to show you guys the facts behind the scenes. So without further ado, let's dig into some of the numbers that we're going to see today. So first thing we want to look at is what the economic calendar looks like today. Let me get out of this one right here real quick. And the first thing we got is ADP payroll numbers. The last reading was 142,000. They expected 148,000 new jobs. What did they get? 296, more than double they expected. How do you miss so bad? How do you miss by, half? Okay, so that's the first thing we're going to talk about. Manufacturing services PMI, so the servicing sector right now is okay. It's holding its own. And non-manufacturing PMI is basically holding its own as well. So there's really not much out today other than the payroll numbers. So why am I not shocked by the payroll numbers? Well, let's dig into it. How many people got jobs? We need to basically look at what sector got the jobs. You can't just say, well, a ton of people are getting jobs. Is that good or bad or whatever? You got to figure out where they are. So let's look at the details. Private payrolls rose by 296,000 for April, above the downwardly revised 142,000 the previous month, and well ahead of the estimate for 133,000. So they were over double off. It's ridiculous. The fastest, here's what we want to look at. The fastest job growth in April came from the leisure and hospitality with gains of 154,000. So think of that, leisure and hospitality, restaurants, bars, the things that were shut down during the pandemic, okay? Those people are going back to work. Why? Well, here's my analysis. Most of those probably became gig workers, Uber drivers, and I'm not, if you're in one of these sectors, I'd love for you to comment down below. But my thought here is you were in hospitality, you lost your job because of COVID, and then you had to figure out something to do. Then the government overstimulated the economy by the gazillions, okay? Thus, it flushed people with money short term, okay? People spent, and that's why we have the inflation we have today. Let me prove you some points here. So we're going to look at right here. This is the disposable income chart. Let me get my head out of the way. This is disposable income. How much people have in the bank after they pay their bills. Okay, so if you look at this on a long-term basis, let's go out over history. Here's where it normally is. So every year people, they strive to have their lives better than their parents and their kids' lives better than their own. So they put money away and they do what they need to do. And they go through here and they continue to save on a good average each year. And then all of a sudden, what in the world happened over here? A huge spike. What is that spike? Let's figure out that time frame. So we're going through here, and then all of a sudden, right at the beginning of 2020 or the end of 2019, COVID hit. And then all of a sudden, everybody lost their jobs. But wait a second, disposable income skyrocketed. Well, look over here in 2022. The highest level of savings ever in the United States. Let's go back all the way from when they kept tracking this. Okay, so there it is. Okay, that proves to you that the economy was overstimulated. Okay, that's that part of it. Then here's what happened is, then people they had all that excess money. Okay, sat back, lived life, spending, Everybody's living life just like it's normal, but not working, okay? Because they had all this stimulus money, but they continue to spend and spend and spend. And that is a chart right here by the Federal Reserve. You can see right here, total outstanding consumer debt in the billions. Over here, where were we just a couple years ago? 4 billion. Where are we today? 20% higher at 4.8 billion in consumer debt. So if you're drowning in debt, and you're a leisure and you're in hospitality, okay, and you used up all your money because the savings account now is gone, what do you have to do? You have to go back to work because you continue to spend and you're running out of money. So that's the first thing we want to talk about is the jobs numbers. The next thing we want to talk about is the banking system really in crisis. So let me just make this a quick little insert to explain to you guys what's going on. And I know I've said this numerous times before, but basically what's happened, and I think it's in this article as well, is the Federal Reserve, by raising rates as fast as they have at an unprecedented level, they're causing turmoil in the Treasury market. So here's what happens is the banks have to hold so much in reserves. So they're taking their money and they're buying treasuries. Well, every time the Federal Reserve raise rates, the value of those treasuries come down. Well, they've raised rates, 10 times in the last year and a half? Okay, so every time they did that, the treasuries bonds or notes that the banks are holding for assets, reserves, are going down in value. Okay, so if you survey banks all over the place, they would be down in value. It doesn't mean they're insolvent because that asset is still at full value eventually, but the only time they have to sell that asset and take that loss or realize that loss is if they have to sell those securities or sell their assets if there's a run on the bank. Well, the funny thing is, the banks that are in question, something happened. Silicon Valley Bank, there was a tweet that went out that said there's going to be a run on the bank. Odd. I'm sure the government should be looking into that. Other banks had their kind of the similar situations happening, and there's only a couple banks that failed. Here's the one thing I want to let you guys know. Here's bank failures. So if people are coming back saying, oh my, it's going to be 2008 again. Here's where we were. And you guys need to understand what happened. Banks all over the world were buying mortgage-backed securities, okay? Those are bonds of mortgages back when the subprime mortgages were in vogue, okay? So banks all over the world bought those assets. They were high yield, and Moody's, believe it or not, stamped most of these AAA ratings. Well, you're an investor, you buy mortgage-backed securities, you have it, you have Moody's AAA rating, and then all of a sudden you find out that bond you're holding or mortgage-backed security is basically worthless. That's what happened. So banks all over the world were collapsing. Look how many collapsed in just the United States. We have, 157 banks. We got 25 here. Hope you can see that. Got 25 here, 140 here, 157 down in 2010. 157 banks in a year. What do we have now? 3. Okay, yes, they're huge depositors, and that's the problem we have. There's so much money concentrated in on specific banks, and the bigger banks, trust me, they're going to more than reap the benefits on this collapse. Just trust me. They're only going to get bigger. All right, so the last thing is, are we going to default on our debt? Well, let's go back over the last 100 or so years. Since the United States has never defaulted on its obligations, the scope of the negative repercussions related to the default are unknown, but would likely cause catastrophic things to happen in the United States and throughout the world. Okay, so trust me, folks. The U.S. is not going to default. They're going to use this as the Democrats and Republicans are going to bang it off and who's to blame and who's this and who's that. And it's coming up to, everybody's coming out for their presidencies. They're going to run for president, all that. So you're going to have this banter back and forth. And then when D-Day comes, they'll extend it or do something. It happens every time. So now what's all this doing for mortgage rates? Well, let's get over to the last reading we have from the Chicago Mercantile Exchange to see what the Federal Reserve is expected to do today. And there is an 82.8% chance the Federal Reserve is going to raise the federal funds rate by 0.25%. How do I know that? Well, the federal funds rate right now is 4.75, which you can see right through here. And that's where we stand. So they're expected to raise it to 5 to 5.25. That is a 0.25% increase, 82% likelihood of that. If they don't do it this time, 75% chance that they're going to do it in June. What do we see from there? Well, from there, after the July meeting, they're expected to start readjusting and pivoting and start to reduce rates, and that's what we're seeing right through here. So based on all this news, what in the world's going on with mortgage rates? Well, here you go. Here's what mortgage rates are doing today. So mortgage rates, these are rates, the top 6 products people use when they're buying or refinancing a property. These are rates published by Mortgage News Daily. These are the averages that you're going to see. Okay, so what this rate is, it represents a person buying their first house. It's their primary home, single family home, 740 credit score, repeat 740 credit score, 20% down payment, okay? And this is what the rate would be. These are the averages. So Mortgage News Daily surveys mortgage lenders all over the country and says, if you had that borrower, what would your rate be? Here's the rates, folks. So to find out what your customized rate would be, all I need you to do is reach out to us. And how do you do that? You can give us a call at 844-775-5626, or you can schedule an appointment, and all that information is down below. Thank you so much, guys, for watching. I'll come back tomorrow, let you guys know what the Federal Reserve end up doing, what repercussions that has through the markets, and what I expect going forward. So thank you so much for watching. God bless. Have a fantastic day, and I'll see you tonight. Don't forget, we have a live event this evening, 8 o'clock Eastern time. We usually go about an hour and a half to answer all your first-time home buyer questions. God bless, folks. Hope to see you then. Bye-bye.